So I see a couple questions on margin accounts. So margin accounts, basically, a couple of ways. If you want to do spreads, you just have to go to your broker and check that you want margin. And a lot of times, like Tastyworks, I know it's pretty easy to do. Every broker is a little bit different. A lot of times, I'll just ask like, "Hey, what do you want margin for? Spreads and stuff like that." It's pretty straightforward. And so, if you want to do spreads now, as I had said before too, if you don't want to do spreads, that's fine. My oldest who does this, he doesn't do spreads. He'll just buy SPY straight out, 50 shares, he makes his $100 and he's done. And that's totally fine too. Um, I focus on SPX spreads simply because there's a lot of advantages and that I like, and so that's my preference. But the setup is the same whether if you just want to do, I just want to buy 100 shares of Spider. Okay, that's fine too. But yeah, so if you don't, with your broker, the main thing is that there are a couple of boxes and permissions that you need to get for things like spreads. Typically you need a margin account and all that kind of basic stuff. And a lot of times, depending on the broker you're with, they'll want to see like experience, and so you just want to, they don't really check. You just gotta like, oh, do you have you done this before? It's like, sure. At least the fact that you saw a class on it is like, oh yeah, okay, I've done this. And so just whatever you feel comfortable with there, just remember they just gotta check their boxes so they can say, okay, this person knows what a spread is or anything like that. Okay. So 120. Put this over here. All right, so let's keep on going here. Just gotta move this around. There we go. And okay. No, cool, Jonathan. Yeah, I think you'll like and see how this all kind of comes together here. It's pretty cool. All right, so why not use SPY or ES futures? So you can, and you certainly can. And like I said, when James did this, he would actually just buy spiders, or buy Tesla and things like that. And the nice thing about it is there's no theta decay, right? If you buy SPY and it goes sideways, it doesn't lose value and there's not an expiration date. So there is an advantage to doing that. I'd say the only downside is that you're not going to get what I would say. Your returns would be more conservative simply because you're not using rapid theta decay and not necessarily using leverage and things like that, and that's totally fine. If you've got a 10K account and you want to set it up where you do 100 shares, or 50 shares, and you make your 2 points, and that's your $100 a day. That's 1% a day. That adds up. 1% a day compounded is like 1,200% a year. So it's not, that's totally fine. And I'm actually very, very good with that. For futures, unless you're doing like the micros, if you're newer to futures, futures, you've got to be more experienced because psychologically, one bad day and you're hosed. And what I just mean by that is with futures, if it starts going against you and you've got the bad habit of like, say, removing a stop, you can just get wiped out because, you've seen, it's like, oh, the futures are down 10. Okay, I'm going to move my stop. And now they're down 100. I mean, you can just wipe yourself out that way. And if you're an experienced futures trader, then absolutely yes. If you're not experienced with futures trading, I do not recommend it simply for that reason. There's easier ways to make money. And so just, that's just my thought on that. Do I do futures? Yes. What percentage of the time? Probably 10%. I actually have just gotten to really appreciate the spreads, and we'll talk more about that. Like I said, it's a lot of times it's ego where it's like, oh my gosh, I caught 80 points. Yeah, so who cares? Did you catch 80 points on the last trade too? But if you're doing spreads, you kind of like, okay, I sold it for 12 and I bought it back at 7, and you can do that whether, it goes up 80 points or it goes up 10 points or it goes sideways, right? And so that's the, for me, it's kind of like, oh, it's not about catching big trades. Like, you don't need that pressure. How do you do the spider for down moves? So, I mean, in an IRA, every IRA is a little different, but you can short the spiders in a regular account. So that in my, that's what James would do. He would, buy the spiders on buy signals or short them on sell signals and different things like that. Yeah, Trader Vic. I mean, we've all done it. He's like, oh, I'm just going to remove it this time. It'll come back, and and you look back on it, and it's just like, man, what was I thinking? And what happens though is the market encourages us to do bad habits because we do that one time and it works, and so we do it again, and it only takes one time for it not to work, right? So part of why I like spreads too is that they're more forgiving in terms of like what your max loss is going to be, right? With futures, typically your max loss is unlimited. If you get caught into a situation like that. Yeah. So Joe, what about buying SPY and selling a call? You can. That just it's one of those things where it depends on the time frame and also just wanting to keep it simple. But yeah, I mean that's certainly a way to do it as well. All right, let's dive back in here, and of course there's TQQQ, SQQQ, and all that kind of stuff too. So yeah, we're gonna talk about specific spreads and things like that too. We'll definitely get into more specifics here. All right. So we talked about that, and okay. So the bottom line is essentially use what is working. And this is such a simple thing to say, but if what you're doing is not working, just stop doing it. And it's weird in trading because in trading, some of our trades are going to work no matter what we do, and some of our trades are not going to work, right? No matter what we do. It's like in baseball. You're going to win 50 games. They have 150 games. Everybody wins 50 and loses 50. It's those other 50 that determine whether or not they make it to the playoffs. And it's kind of similar in trading. If your ego demands that you have a 97% win rate, okay, great. You can sell 2 standard deviation iron condors and you're going to win 97% of the time. It's just that the 3% of the time you lose, you're going to lose huge. And so, the thing about it is this, at the end of, are you, do you have an upward sloping equity curve over time? And if you don't, you just got to really be honest with yourself. Like, okay, what's not working here? What is it? The occasional big loss. And a lot of times that's what does a lot of people in. It's just like, it's that, that one trade, man, what if I had not done that one trade? And so just kind of really, look at that stuff. And so part of this setup is to help prevent some of that stuff too, right? Trading fools us because no matter what we do, sometimes it works. The question is whether or not it is providing consistent results over time. All right, so for the SPX specifically, what are the worst trades at the open? So we're going to talk about specific times here. And again, don't worry if you're newer and you're not really sure what a spread is or anything like that. That's not critical right now. We'll get into that in a little bit. But the worst trades to do at the open are going to be iron flies and iron condors. Okay, why? Uncertainty around the first 2 hours keeps these premiums high, and there's little benefit to theta decay. In other words, they become a directional trade. Okay, you're not really capturing decay. Tip, the best time to initiate these trades is after 10:30 a.m. Central when the premium decay starts to accelerate, and then after 12 noon is even better. Yeah, Bob, and for the S&Ps, there's a saying in the S&Ps that it leaves no stop untouched. And the spread on a spread, you can hold through a 30-point move in the S&Ps and it doesn't hurt that bad. Whereas the futures would just stop you out. And so that's kind of nice too. All right, so 8:30 to 10:30 a.m. Central. I'm always looking to do a trade here. And typically, the only thing I'm doing here is an at the money or in the money credit spread. So if I get a buy signal, I'm doing a put credit spread. If I get a sell signal, I'm doing a call credit spread. Okay. If you don't know what that is, and again, don't worry too much about this because we'll cover it. But if the S&Ps are at 3,900 and I get a buy signal, I'm going to sell the $3,900 put. Okay, I don't want to be naked, so then I would like buy the 38.90 put, right? And that's the spread. I'd get a credit of $4.50. And then as it goes, if it starts to go, then I try to buy it back at about $2.50. And that's it. And I know, and it doesn't sound sexy, and it took me a while to get my arms wrapped around it, but I couldn't argue with the results. And what I typically do on a large account is I do one contract per 20K in the account, and I'm doing $25 wide spreads. Okay. So if you have a $100,000 account, then you could do 5 contracts, okay, at $25 wide. And basically, you're selling it at about 12 and you're buying back at 7. And, we'll get into more specifics on that. And that's it. And what's nice about this is this works whether if the stock is grinding, if the market's grinding all day and doesn't really go anywhere, this is still possible. Obviously, if it takes off, it's possible faster. And of course, in both instances, if it rolls over, and the thing about it is, if it rolls over, you don't sit there and just wait until you get max loss. You get out. So there are signals to say, hey, this trade is no longer working. Let's get out. So, so then 10:30 happens, right? So 8:30 to 10:30, all I'm doing is credit spreads. Buy signal, I'm going to sell put credit spread. Sell signal, short signal, I'm going to sell call credit spread. That's it. That's all I'm looking for. Keep my life easy. Not scanning for stocks or anything like that. And the morning is typically the most active, so I really like just honing in on one thing to do, and that to me has been pretty great. So then, what about 10:30 Central? So 10:30 to 12. So now I'm still doing credit spreads, okay, and I will look at the money, but this is also the sweet spot for the out of the monies because you're starting to get that rapid theta decay. And so what I've found here, again, now when I say a $25 wide spread, do you have to do $25 wide? No, you can do $5 wide, right? You can do what you're comfortable with. So what I found here, so again, let's just say we're at 3,900 and I get a sell signal, okay? So, and this is at 10:30. So I can sell the out of the money 39.25 call, okay, and then buy maybe the 39.50, or whatever you want. This is about a $5 credit. Now, what's great here is that if the market, trades sideways, you can see this theta dropping real time. If the market grinds up, it's still dropping, right? The theta is so fast. Now, obviously, if it explodes higher, you want to get out of it. If it, especially if it gets up to that sold strike. Typically on something like this, I'm selling it at 5 and then buying it back at 2 in about 30 minutes, give or take, just depending on what's going on there. So I like that quite a bit. And then, so certainly more risk in that, but I use the same signals. And obviously we're going to, we'll get to the signals towards the end of this presentation. And then typically buying it back at $2. Then what about from 12:30 to 1:30? Typically at this time, I'm taking a break. I have found personally staring at the screens all day, gets me, I got to move around. So I have found that I used to work out. I don't like working out at 6 in the morning, to start off at 6 in the morning and like doing like heavy deadlifts. It's just not, it just doesn't work for me. A walk or something like that in the morning is fine. But around 12 to 1:30, give or take, typically I do I'm doing a workout in the gym, strength training. I'll do yoga, something to move, to counteract me not only staring at the screen but also sitting. All that stuff is you got to move around. And I'm also sipping on a gallon jug of water all day. I try to, drink that gallon a day, which is, when you first start doing it, it's like, man, I got to pee all the time. But after a while, your body appreciates it. So then about 1:30 to 3, I'm back. And at this point, I'm basically now more interested in a different kind of trading. And I'm more interested in cheaper trades at lower risk. Okay. So in the morning, yeah, I'll do $25 wide spreads and stuff like that. But in the afternoon, typically, even if you're going, if you're doing an at the money $12 wide spread, you're not getting much of a credit at that time. And so you might get like a $5 credit, which means you've got $20 of risk. And in the last hour and a half, we've seen the market explode or get killed. And you got to be, you want to be fast. You don't want to be, you got to be fast enough to react. So, and at this point, typically, if everything's going fine, I've got some decent profits on the day. Ideally, I've actually made my daily goal at this point, so I don't want to piss it away. So it's just a different kind of trading. So I want to find trades that are very low risk, and if they don't work, it's not material. But if they do work, it's a nice little, kind of cherry on top at the end of the day. So, in this now, that's when I'm looking at these. Now, again, if you're newer to options, don't worry about butterflies or unbalanced flies or iron flies. Those are what I like to do. You could also do, like, say, debit spreads and stuff like that. So again, if you know what those are, awesome. If you don't, it's immaterial. Not a big deal, because we'll talk more about specifics and things like that, because you can do credit spreads the whole time. But in a perfect world, by 1:30, I've already hit my goal, and I'm actually not necessarily needing to do any additional trades. That said, the cardinal sin here would be to go from being up on the day to down on the day. So if you are trading into the close, you want to do smaller size and smaller risk. If you are scrambling in the last 30 minutes to try to hit your goal, a lot of times that can lead to errors, right? So this is a time to kind of be cautious, take advantage of the cheap options that are setting up, and doing things like that too. All right, so here's kind of a graph of how the type of trades I'm doing. So in the first 2 hours of the day, I'm typically looking at those in the money and at the money credit spreads. Okay, so again, if I get a buy signal, all I'm doing is selling a put credit spread, and then if I get a short signal, I'm selling a call credit spread, and that's it. And then as we get to 10:30 to 12:30, I will look at the money or out of the money credit spreads, and I'll also consider, sometimes I'll do iron condors for the next day. All right, and that's something we'll do during the live trading. I found that there's this thing, like, from noon to noon is a good time to do condors, because at noon you got to have a good idea of what kind of market it's going to be, and then you can go one standard deviation out, and then as long as there's not like an FOMC meeting or something like that, and they've been pretty consistent as well. And then during the last part of the day, that's when I'm looking at the cheaper things, like let's do debit spreads, out of the money debit spreads, iron condors, et cetera, et cetera. So what specifically then does all this mean? So let's do this. This is a strip out the noise summary slide. So if you're newer to all this stuff, don't worry about, my God, what's a butterfly? You never have to do a butterfly if you don't want to. This is all you have to do right here. So, so let's say here that the S&P SPX is at 3,900 and we get a buy signal, right? And we're going to talk about what those are later. Now, depending on your account size, this is going to be like let's call this a 10K account, 10K to 25K, give or take. And this could be 25K to 100K, and this could be 100K above. And it's just, those are just guidelines, right? So I get a buy signal. We're at 3,900, so I'm going to sell the $3,900 put and buy the 3,895 put simultaneously. That's called selling a vertical. I'm going to get an approximate credit of $2.25, and then I'm going to place an exit order for $1.35. All right, so I'm just going to place an exit order for $1.35. Or if I do it $10 wide, okay. Yeah, and if you are newer to options, definitely look at the Options 101 course. That'll help you with all this stuff too. If I got a medium-sized account, I can go $10 wide. I get an approximate credit of $450, and then just put an exit order for $270. Okay, and then what I do, $25 wide, typically I'm going to get about a $12 credit, and then I'm going to place an exit order for $720. And so my ballpark target on these is about 60% of the credit received. So, or is it is my math right on that? 40% of the credit received, I think, is what my math is. 40% of the credit received. So I'm not looking for a killing here. I'm not looking for this to, like, oh gosh, I'm going to sell it at 12 and I hope that it expires worthless. I actually don't want to deal with that, because then you got to sit there all day and hope it doesn't come back against you. What I'm looking for is that meat. If you sell at the money at 12 or at 450 or 225, and you get that buy signal, and even if the S&Ps only go up 10 points, you typically can get out at these levels. If it just, if it goes up faster, you get out faster. And so it just makes it nice, and it's a guideline that we can do on that. Okay. Well, so what about placing stops? So you don't want to place a stop on a spread because you'll just get stopped. So just remember, if you sell it for a 225 credit, your max loss is 5. Like, you can't lose more than that. But guess what? The only way that's going to happen is if you hold on to it till the end of the day. So when you get a buy signal, great. You're going to stay in this until your target's hit, or you get an opposing sell signal. And in that case, if your target's not hit, you just get out. So we're never holding to max loss, right? So that's what you position size as if you're going to hit max loss, but we never hit max loss. All right. Now, could something happen like an earthquake or a tidal wave, and all of a sudden, the markets are against you by 100 points? Yes. But that's what the spread. That's why we have a spread, and we're not long futures where you just get completely annihilated. Yeah, and if you do have a cash account, the one thing to do is ask if you can get a margin account, and then if you can't, that's fine. My son, he would just buy spiders or short spiders or whatever stock he was looking at, and that's fine too. Okay, now what if you get? Okay, that's for a buy signal, right? If you get a sell signal, then same situation. So you got smaller account, so smaller account, medium account, larger account. So we would sell the 3,900 call and buy the 3,900, the 3,905 for protection, and we'd get a credit of 225. Or we could go $10 wide and get a 450 credit, or $25 wide and get a $12 credit. So we're talking about the same numbers, which is kind of nice. And then I'm going to place orders to buy it back at 40% of max profit. Typically, these trades last about 30 minutes. Okay. Whether, most of the time they work. And if they don't, I've gotten in at 225 and I get out at like 290, if it rolls over or something like that. It's not, if it goes against you, the premium is still there, right? It's not like, oh my God, I just went to max loss. The only way it's going to go to max loss if you hold it all the way into the close and you don't take any action and it goes against you. So does this make sense? So essentially, for this whole thing, it's like, oh gosh, okay, I got the signal. I'm going to do the spread. I'm going to place an order to buy it back at 40% of max profit, and I'm good to go. And by 40% of max profit, all you got to do is just say like, okay, if I did $10 wide, so $10 wide, and I did a 450 credit. And then if you just multiply, so when I say that, let me add this on here because this sometimes gets confusing. Let's see. Tip. To figure out exit, take your credit, take your credit received and multiply by 0.6. 450 times 0.6 equals 270. Let me just double check and make sure I got that correct. Yeah, so 4.5 times 0.6, yeah. So that's what we're doing. So we're not even trying to we're not trying to catch big moves here. We're trying to catch the easy move. We're trying to grab the cash, right? And this honestly has been something that I've had to learn because there are and look, there's certainly times when had I held on, I would have gotten max profit. That happens a lot actually. But then there's times when I get out and it rolls back over and I'm thank God I got out. So the idea with this is consistency. So I would encourage you, is if you're new, to place your exit orders right away and just don't worry about it so much. Don't worry about, oh, what if I would have made more? And then we'll talk about, if you do get a signal that you have to get out and it's not hit, then, we'll talk about what to do there. But this is a solid plan where you can make, if you do this like twice a day or even once a day, you're looking at 1%, and you got to do it a couple times a day if you're going to, potentially get to 5%. But you're looking at, anywhere from 1% to 5% of your net liquidating value each day, depending on the risk that you're comfortable with. And so you just want to play around. This shouldn't be stressful. You want to find what's comfortable for you, and you want to get over the idea that you have to catch big trades. Okay, you just want to capture the flow of the premium decay, the gift that the SPX 0 days to expiration options are providing for us. Okay. So those are the exit guidelines. Yes, there will be times where if you had held on longer, you would have made more money. And yes, there will be times when you get in and you set your exit, and then you have to change it and get out because the exit signals show up before your actual target is hit. All right, that's fine. But that's, that multiplier of 0.6 is a pretty high probability target. And my idea with this is that as you're playing around with this, if you get filled, get your exit going right away. And that way you're just, that's the discipline. That's the discipline part. Or if you do 2 contracts, do one at that multiplier, and then wait for the signal on the second one. So that's, a couple ways to do that. Let your orders do the work for you. It's also fine to have multiple orders to scale out. One of the things that I like to do here is at least on Tastyworks. I don't know if this does this on Thinkorswim as well. If you go to the gear tab and you go to order and trade, and then you click on, because this isn't clicked normally, duplicate trade immediately after send, what will happen is that, when you send your order and you get filled, it automatically tees up the exact same order again. So I like to scale in and then scale out. And then that way I don't have to place the order every time. You got to be a little careful, and then, you don't want to make sure like, oh yes, I'm exiting here, I'm not entering. But that's a nice little feature that I like, because I'm doing large size, and so I kind of like to, scale in and scale out that way. If you're doing 3 contracts, you could do this 1 contract at a time, 1 spread at a time, and that's fine too. So either, either way is fine there. Since the moves in the morning can be fast directionally, I tend to go at the money or even slightly in the money. And again, typically what I do is I sell a $25 wide spread for 12 bucks. If you've got, a smaller account, you can do $10 wide, you can do $5 wide. I'm looking for a move in my favor back to the key moving average, and that's the part we're going to talk about next. Spread falls to about 7, and I'm getting out at $500 per contract. So if I've got 10 contracts, that's $5,000. If I've got 100 contracts, that's $50,000, et cetera, et cetera. If the trade doesn't work, or I get a signal to get out, typically the spread and I get deer in the headlight syndrome. Okay. So you got to take action, but you don't need to guess. It's like, oh, it's telling me to get out. Okay, great. I'm going to get out. And what's great about this is that on the S&Ps, a lot of times, if, the S&Ps will drop 20 points and everybody's getting stopped out, right? The SPX can drop 20 points and your spread moves 2 points. So they're very, very, very forgiving, especially in the first couple hours of the day there. All right. And so that's pretty good that way. Okay. What cut out? What was the thing that you heard before that I guess it looks like I cut out for a minute? Oh, okay. So the beginning of the slide. All right. So the main point here is, okay. So, let's see. All right. So a couple things here. So typically if I'm getting in at 12 and then out at about 7, it's $500 a contract. And, if you get 10 lots, that's $5,000, 100 lots, that's $50,000, et cetera, et cetera. So the nice thing here is that let's say that you were long the S&P futures, right? Well, if they drop 20 points against you, most people are going to get stopped out on that. I mean, 20 points, that's $1,000 a contract. A spread, if you get in at 12 and it drops 20 points against you, basically the spread's going to go to like 13.50. So a point and a half. So the spreads are very, very forgiving, especially in the first 2 hours of the day, because the premiums on both of those contracts are pretty high. So that's the, my aha moment with that is that if it's going against me, it's not that big of a deal. Now, if I get an exit signal saying like, okay, not only is it going against me, but now I've got a signal that it's rolling over, then yeah, I get out. But the point is that, even if it's against you by like 20 points, it's not that the spread doesn't move very much. And so what I love about this is that when you're wrong, you're wrong small. When you're right, you get your 5 or 6 points in this case, or 40% of the credit received, and you move on, which is great. Okay. So I talked about that. And then, okay. So what about the last hour of trading? Now, again, this is a little bit more advanced. If you're newer, don't worry about this stuff. But what about the last hour? So these are some things that I would do in the last hour. I could sell, like, say, a $10 wide iron fly at 3,900. So that with iron fly is essentially you're taking a call credit spread and a put credit spread at the same strike and smashing them together. Typically, you're going to get something like an $8 credit. So your max risk is $2, right? And if you establish it after 2 o'clock, you can capture that last hour of theta decay. The pros are you get a fat credit and a low max loss. The cons are you're looking for the market to kind of stop moving. So you're looking for kind of a choppy close. All right. Big tip here that I have is that you can make a nice living selling this at 8 and buying it back at 6. Where people get in trouble with this is they sell it at 8 and they want like, oh, I want to buy it back at 2, right? The only way you're going to buy it back at 2, well, first of all, you're not. Okay, here's a dirty little secret. If you're trying to buy back at max profit, you will not get filled. The market makers will not fill you that low. And what will happen then, you're at 3,900, you're trying to get out. And then in the last, 6 minutes, it pops up 10 points and you go to max loss. Okay, that's how the game is played. So guess what? Play outside of the game. Sell it at 8, buy it back at 6. Don't wait till the last minute. So that's the way around that. I know it's not as sexy, but again, grab the cash. If you're walking down the street and you see a $100 bill, are you going to ignore it? Right? So you want to grab the cash. The other thing you could do is you could buy a $10 wide butterfly for $2, or if you go further out of the money, they're even cheaper. I don't mind these, but then, again, are we going to get that pin? And, I'm the first one to raise my hand and say, sometimes pins happen and then sometimes they don't. And a pin just means like, oh yeah, it closed exactly at 4,000 and I had the 4,000 strikes. So a butterfly is essentially you're taking a debit spread and a credit spread and smashing it together. And then in this case, the max profit would be at the $3,900 level. So if you bought it at 2 and we closed at 3,900, then basically you would have bought it at 2 and you would have exited at 10. Right? That's a great 5x trade. Good for the ego, right? However, the odds of that happening are pretty low. And if you're at 3,900, 5 minutes before the close, they're not going to let you out. Okay, you're trying to like, oh, I'm going to get out at $8. No, you're not. They won't even let you out. So that's, again, dirty little secret of the market makers is they just kind of sit back and they keep those premiums elevated right till the close. However, you can get in at 2 and get out at 4, okay? Or let it cash settle, hope that you're in that zone there. So a couple little things like that. Yeah, William, I do think that the end of day, it's a scam. So just be aware of that. It's the market makers, they got to make a living, and that's one of the ways they do it. They don't let you out at the end of the day. So just got to be aware of it. The ways around it are have smaller targets, let it cash settle. Doing wide butterflies like the day before for cheap, things like that. That way you don't really care. So, but again, if you're newer, don't worry about this. There's so many other ways to kind of be consistent. But what will happen is that as you kind of get the hang of it and you're looking to do other things, you just want to make sure that you're not getting fooled by the market makers because they're not your friends. They're there to fleece you basically. The other thing I'll do once in a while, and I'm not I don't know. I'm not a huge fan of these. So let's just say we're at 38.75 and you could get the 38.9, and this actually would be more realistic, for $1. So then if we explode into the close, it's going to go from $1 to, $10, and you could make, 9x. And again, that's very satisfying. Wow, I made 9x. But again, the odds of it happening are low, right? And you do often need a big move for that to work. So will I do it once in a while? Yes. Again, I'm not trying to bet the farm on it. I'm just kind of, seeing what it is. But that last hour can always be a little tricky. Instead of pins, one thing I found is that credit spreads work better. So for me anyway, so if the SPX is at 39.90 and everyone is looking for a 4,000 pin, oftentimes it's going to kind of do some head fakes. And so I might say, sell a slightly out of the money call credit spread. So, again, this is the kind of stuff, if you're newer to this, don't worry about it. This is not a key portion of this. This is really just kind of like, all right, last hour, there's a lot of premium decay. How do we take advantage of it? And certainly we'll do that during the live trading as well. So the secret to all this is to stop looking for home runs. I would rather do a large position for a small return than a small position hoping for a home run. All right. The small position hoping for a home run, I think, causes more problems than anything else in trading. When you could just do a large position, get that small return, and keep doing it over and over and over again. An example, if I buy one out of the money $10 wide call debit spread at $1, and I'm hoping for that max profit of 10, so I can get that $900 profit, I could also just sell a 10 lot of the SPX Iron Fly at 8 and buy it back at 7, okay? And I get the same $900 profit, but the odds of that second one working is like 10 times higher than this one working, right? So that's what I mean by that. And that it's just you want to play the game the way it's rigged is the way I look at it. So the first one is nice when it happens, but it doesn't happen a lot. And the second one, it's not that exciting, but it happens a lot. So if you're in this for excitement, that's going to drive your trading. And if you're in this to make money, that's going to drive your trading. They're different things. And what I've learned over time is focus on grabbing the easy cash, not satisfying the ever demanding ego. Okay, so we did the intro, why SPX and 0 days to expiration. And so what I want to do is the origin story part this is the easy part. This is a little bit less technical. And then we're going to dive into the tools, and then we're going to dive into the setups. Okay, so this is what we're getting to. And, this is kind of the chart we had talked about, we'd shared and stuff like that. And so we're going to get to this. And so, and the stuff that we've been talking about here, it's kind of like, okay, what are we looking at here? Oh gosh, here we came down to a level, we got some arrows. So I'm selling a put credit spread, right? And then it rallies and I sold my put credit spread for 12 and then I get out at 7 and that's it. And if you're, that's as simple as it is. And then when it gets too far away, up here, what do you do? So that's the part we're going to talk about here. So how did all this happen? And really, and this, and there's just a few slides on this, but I think it's important just to kind of see where, the where and the hows and the whys of all this as well. So how did all this happen? So it basically is because my oldest son came to me and said, hey, can you teach me how to trade? And what's the irony of this is that, over the years, my two youngest have always been interested in trading. That's my youngest, Dylan. That's my daughter, Avery. And they like doing trading. And they don't do it all the time. I mean, they got, they're in homeschool and stuff like that. But, Dylan will come in and is like, hey, I need to buy some Robux. Can I look at some charts? And, we'll set it up and he'll look and, he'll do the trade. And, he typically is in it for a day or two and make his $100 and then he's good. Avery at one point wanted to buy a computer for her cousin, and that took a couple of weeks of trading, and she got it. So what about James? Well, is my oldest, he, for whatever reason, he just, he just never got into it. And in fact, he'd get irritated, like, "Oh God, Dad, I don't want to sit in front of the computer." It's kind of funny, and we joke about it, but I'm like, fine, I get it. You want to do your own thing. So then, at the start of this past summer, a couple of his buddies were working at Subway, and he was thinking of working with them. And then he kind of asked me, he's like, well, I asked him how much they made, and they said after taxes they make about $80. And he's like, could I make $80 a day trading? And I was like, well, I said, I'll show you a setup. I think it's possible, but you have to do it. I'm not gonna, babysit you or anything like that. So I need to find a setup that you can do on your own and do this. And he's like, awesome. So I was super excited about this because, like I said, my two youngest have always we've kind of been on the same page all our lives, or all their lives, and James and I have been more kind of butted heads on some things like that. So I was like, all right. So I was excited about this, but I was also terrified. Like, this is my chance, to bond, and I don't want to screw it up. So my one concern is, like, I've been doing this for like 30 years, and I didn't want to throw so much stuff at it that that he quickly became overwhelmed, right? And just like, because too much information overwhelm can also be defeating. He could lose interest in it, all because of my approach to this. So a total nightmare scenario for me in so many ways, because I'm like, I know I can show him how to do this, I just don't want to screw it up. And so I had to think, what would be simple for him and would also work. And I kind of made a note, like, what did he need to see to have confidence in this? Because he didn't have the trading bug at this point. It's like, I just, is this a better alternative to Subway? So he's going to have to see consistent results. It's going to be hard to get excited about learning the skill if the results are all over the place. Clarity on when to enter a trade. So no ambiguity was a big thing. Being comfortable staying in a trade. So like when you're in a trade and you get nervous, I want to be able to look at this and say, okay, am I making the wrong choice here? Or like, no, you're fine. Like, okay, I want to visually be able to see that. Clarity on when to get out. And then no guesswork. And so that was kind of it. And so the first thing I tried, and we just did this for a day, is like, okay, I'm a fan of the squeeze. Like, let's just do, he's going to day trade. So let's do 5-minute squeezes. So here's a squeeze, we pop up. That's great. But this market, unfortunately, is so all over the place that the 5-minute squeezes aren't easy to do. So like this one, yeah, it fired up, but so he was asking me a lot, well, do I go long here? What do I do? I'm like, okay, well, this isn't going to work. And I love the squeeze on larger time frames, but on a 5-minute chart in this environment, it's like, okay, what do we do here? So I didn't want to start going like, well, you got to look at the ticks and you got to look at, I didn't want to, I wanted to make this easy. So, again, we clarified the goals. His goal is to make $100 a day, no overnight trades. He's going to use stocks, not options or futures. An easy entry signal that he could follow, even if I wasn't around or if I'm on the mic in the trading room or something like that. An easy exit signal. And then consistency. This is a really big part of this. Consistency was way, way, way more important than making a big trade. So that $100 a day was the important thing, not, oh my God, I caught $1,000. Okay. And that was an important distinction. So basically, I had to reverse engineer a solution to this problem. And in addition, I didn't want him to have, to constantly ask me what was happening or what he needed to do. And he just wanted to make his money and be done. And so, a lot of times when you swing trade, what happens is, you might get into a trade and you're up for a couple days, and then it goes against you for a couple days, right? And then it might be 3 weeks later that you finally exit. And you just got to learn to kind of hold through that. And I knew that would fail. Like, that's not what we're looking at here. But I also didn't want to, hyper scalping. There should just be 1 or 2 trades a day. And so the idea with this is just kind of understanding, like, okay, no matter what time frame you're looking at, a monthly chart or a 5-minute chart, you're going to have a series of highs and higher highs and lower lows at times. Sometimes you're going to be trading sideways, and sometimes you're going to be having lower lows and lower highs. And so the idea with this, the kind of trading I wanted for him, is I didn't want him to have to hold through all these ebbs and flows. I just wanted him to catch an ebb and flow, and that's it. And so that was an important distinction too. Okay, so what were the things that we started thinking about with this? And so the first thing that we looked at, and this is something that we even talk about in the Gold Room, is that on an intraday basis, on a 15-minute chart, the 8 EMA is going to get tested multiple times. Okay, So, here we gap down, we test the 8 EMA, we push down, we test the 8 EMA, we push down, we test the 8 EMA. Oh, we push through it, we come back to the 8 EMA. We gap down the next day, 8 EMA, right? This 8 EMA typically gets tested 3 to 5 times a day, if not more. Okay. So this was important. The 15-minute chart, the 8 EMA, this is going to get tested multiple times a day. And so if we go back and we look at this, the idea with this is just like, if you could picture that the 8 EMA was just kind of running through the middle of this, then at some point, if you get too far away from that, you're going to come back, right? And if you get too far away from it here, you're going to come back. And if you get so that was the idea, is like, okay, let's just look for times when you get too far away from that and you kind of snap back to that level. And this could happen multiple times a day, right? Because on a daily chart, the 8 EMA, it might not get hit for weeks if it's a really strong trend up or a really strong trend down. So that was the first one. However, as I started playing around with this, and of course, from my own intraday trading experience, I realized that there were also other key moving averages for larger trends. And so the other one was on a 30-minute chart was the 21 period moving average. And this was my favorite one. So you get a gap up, guess what? Boom, you're coming back to the 21. You gap down, you're coming back to the 21. Oh, we're going to push lower again. We're coming back to the 21, right? We gap down, we're coming back to the 21. We push up, we're coming back down to the 21. And these are big moves. I mean, this was like a 35-point move down. So this was important, like gap down, we're coming back to the 21, gap down, we're coming back to the 21, right? It happens over and over and over again. In fact, that's the trade I typically do first thing, is if there's a gap up or a gap down, is I'm looking for that move back to the 21 EMA on a 30-minute chart using spreads. And then I was like, okay, well, geez, on the hourly chart, there's a 50 period EMA, and this is just good for those bigger moves, right? And it's not going to get hit every day, but a couple of times a week, there's a nice snapback. And so I want to know where that is, right? Wednesday of this week, right before CPI, we were there, and now, this 37.97 is going to be a magnet again. Are we going to hit that next week or not? I want to, we'll see. And then last but not least, for the larger ones on the daily chart, was the 5 EMA on the daily chart. So again, if you get, what I found is if you typically get about 1% away, you're going to come back, and you often test this almost every day. And if not every day, like every other day. The 21 EMA, you might go weeks without testing it, but the 5 EMA, boom, yeah, we're pretty far from it right now, right? But I mean, look at this volatile week. It's testing it almost every day. So that to me was important. Okay, so now we're looking at this, and we've got the key moving averages here from different time frames, and that's what we want to bank this on. Okay, so these are the key moving averages, and you'll notice here that this is multiple time frames. And if you're looking at multiple time frames, you're going to have an edge because most people don't. So we're looking at the 8 period, and EMA stands for exponential moving average, from the 15-minute chart, and I color code that yellow. And then we're going to look at the 21 EMA from the 30-minute chart. I color code that white. The 50 EMA from the 60-minute chart, light blue. And the 5 EMA on the daily chart is lime green. Now, if I could only use one of these, what would it be? It would be the 21 EMA from the 30-minute chart. And sometimes I have only looked at that. But what I find is then I'm like, well, geez, I actually want to know, are we below the 5 EMA? Are we trending below it, or is it higher? So I go back and forth on that. If I could only do one, that would be it. But I'm also comfortable, looking at all of them as well. So for James, what I did, I just had him look at one, because again, I didn't want it to be too complicated. For myself, I like to look at all of them. So, but my whole thing with this is I didn't want to have like, here's 4 charts. And on this chart here's the 8 EMA, and here's on the 15-minute chart, and here's the 21 EMA on the 30-minute chart, and here's the 50 EMA on the 60-minute chart, and so anyway, I had to so I talked to Eric, and he sent over a script, and boom. So now on this 5-minute chart, I can sit there at a glance and say, okay, great. Here is the 8 EMA, okay, on the 15-minute chart. Here's that 21 EMA from the 30-minute chart. And then here's that 50 EMA from the hourly chart. And then there's the 5 EMA on the daily. Okay, so now at a glance, I can sit there and say, okay, great. Geez, we're going to test the 8 multiple times a day. Oftentimes we're going to test the 21 at least once a day. The 5 EMA on the daily, that's a ceiling. And this right now it's a ceiling. So any rallies to that, you short. And to an extent, so is the hourly. So the action is here, the 21 and the 8. And then this kind of gives us a sense of is the pressure to the downside or to the upside. And so to me, it just kind of gives me a nice view of where the markets are. Does that make sense? So, again, it's like, okay, geez, if we're going to be, at the very least, if we gap down like here, yeah, it looks ugly, but guess what? It's going to test the 21. And in this case, it's just like, all right, we just kind of ground. And on something like that, it's going to be easier to hold a put credit spread than directional. And then you look for an opportunity, like if we get up here to the 5 EMA, guess what? We're looking to sell call credit spreads in this case. Or dear God, if we rally all the way up to that falling 50 EMA from the hourly, guess what? We're going to be looking to sell call credit spreads. And so what I love about this is it really gives me a nice flow of what the market is doing on multiple time frames. And I'm not, it's like, oh, should I buy it right here? No, because we're far away from all this stuff. So that's the first thing. That's the first thing I like to look at. Yeah. Now, good question. A lot of times it's kind of like, okay, well, geez, here's the SPX. So are you looking at the cash session or are you looking at the overnight session? I just look at the cash session. So I've tried both. I'm not a huge fan of looking at the overnight session on, like Tesla, stuff like that. However, I will also look at the ES. The levels are going to be different. The movement is the same. Once the market gets going, I find that the SPX is typically the more powerful of them. But I will look at both. But if you just have to pick one, this is absolutely fine. Okay, so how far? So the next question from this is this, okay? So we've got all the moving averages, right? And so the question is going to be like, okay, well, geez, we're going to snap back to the 21. How far do we get before it typically snaps back? Okay, what's the percent from that 21 period moving average? And I found that generally once you get to about 0.75% to about 1.25%, it's hard to go much beyond that. And certainly you can, but again, think of this as a magnet. If it gets too far away, it's got to run back home and check with mommy, and then it can go again. And so that's the kind of so I found that that's pretty helpful. So so I found is that range of 0.75 to 1% from one of these key moving averages, the odds of a snapback is very high. And it's a good reminder not to chase. If it's running away without you and you're 1% away from one of these moving averages, don't chase it because we know it's going to snap back. So now this is kind of the update I made with the chart that I shared in the room this morning. Is on the 5-minute chart. I can now see at a glance that where we closed on Friday, we closed 2.37% away from the daily 5 EMA. We're 0.41% away from the 21 EMA on the 30-minute chart. We're 3.25% away from that hourly, and then and then we're actually over the 8. So again, the 8 and the 21 get tested every day. So yeah, sometime I don't the 5 will very likely. I've never seen a week where it's not been tested. It changes every day, but the idea that we can kind of come back up here again certainly makes a lot of sense. All right. So hopefully that's pretty self-explanatory, but that's the idea. So that's the why of the moving averages. Again, if I could only look at one, I would be looking at the white one. That's the 21 EMA from the 30-minute chart. But I have found added value in looking at the rest of them. So if you're looking at this going like, well, I want to make this as simple as possible, this one's fine. But what I like about, the 5 from the daily and then the 50 EMA from the hourly, I mean, it's not a secret right now. The trend is down, right? And so it kind of keeps me from getting too excited if we see a rally. And, this spike right here, right into that just got absolutely destroyed. Okay. So what time is it now? 2:14. All right, it is time. This is a good place for a break, actually. And yeah, and if you guys go, if you see at the presenters post, I posted a link for a chart, and that has that has this right here. So I did a few tweaks where I added more of the percent from EMAs and stuff like that, and that's the one that's shared up there. All right, so let's go back and find. All right, it is what time is it? 2:15. So let's come back at another 10-minute break here. So we'll be back at 2:25 p.m. Central. And I may not be able to find the clock. Well, we'll be back at 2:25, all right? Back in 10 minutes.